Gold hits $5,100 as central banks add 127 tons in January, while Western ETFs bleed 89 tons in the same period. It's Thursday, February 5th, 2026, and we're witnessing the most dramatic divergence between institutional accumulation and retail panic in precious metals history. While mainstream media celebrates the recovery rally, the underlying structural shifts tell a completely different story. Gold is now trading at $5,100 per ounce, up another 2% today, marking a full recovery from last week's flash crash that saw prices briefly touch $4,350. Silver is holding steady at $91 per ounce after its explosive 26% bounce from Monday's lows. But here's what nobody is talking about. The composition of buyers and sellers has fundamentally changed. Central banks around the world added a record 127 tons of gold to their reserves in January alone, the highest monthly accumulation since data collection began in 1950. At the same time, Western gold ETFs experienced outflows of 89 tons, meaning retail investors in North America and Europe were selling, while sovereign institutions were buying aggressively. This is not a coincidence. This is a structural realignment happening in real time. Let's break down what's actually occurring beneath the surface, because the headlines are missing the entire story. The People's Bank of China reported adding 15 tons to official reserves in January, but unofficial estimates from import data suggest the actual number could be closer to 60 tons when you account for non-disclosed purchases through state banks and sovereign wealth channels. Russia added 8 tons, despite Western sanctions making transactions more complex. Turkey added 22 tons, continuing its aggressive accumulation that began in 2023. Poland added 19 tons, signaling Eastern European central banks are front-running what they see coming. India added 11 tons through RBI purchases, separate from the massive consumer demand during wedding season. And here's the kicker. The Reserve Bank of India just announced they're exploring a formal gold accumulation target of 1,000 tons over the next 36 months to reduce dollar dependency in their reserve composition. These are not trivial moves. These are strategic positioning decisions being made at the highest levels of monetary policy. Now contrast that with what's happening in Western financial products. GLD, the largest gold ETF, saw outflows of 47 tons in January. SLV experienced outflows of 1,850 tons of silver equivalent. European gold ETFs collectively lost 31 tons. Canadian and Australian gold funds down another 11 tons combined. Retail investors who purchased gold and silver during the 2024 run up to $5,900 are capitulating after the recent volatility. They bought the top, got shaken out by the flash crash, and are now selling into the recovery at a loss. This is classic weak hand behavior, and it's creating the exact conditions for strong hands to accumulate at scale. When central banks are buying and retail is selling, pay attention to what the central banks are doing, not what retail is doing. Governments have information access and time horizons that individual investors simply don't have. Let's talk about what triggered this entire sequence of events, because understanding the catalyst helps predict what comes next. On January 27th, the Federal Reserve held rates steady at 4.5%, but released updated economic projections, showing only one rate cut expected in 2026, down from the 3 cuts projected in December. The market immediately repriced rate expectations. The dollar spiked 2.3% in one session, and gold got hammered as leveraged positions were liquidated. Silver, being more volatile, fell even harder. Comex margin calls went out. Forced selling accelerated. Algorithmic trading programs piled on. We saw a classic liquidation cascade, but here's what the algorithms and leverage traders missed. Physical demand never wavered. In fact, it accelerated. U.S. Mint reported selling 155,000 ounces of gold eagles in the final week of January, the highest weekly sales since March 2023. Perth Mint in Australia sold out of 1-ounce gold bars with delivery delays extending to 6 weeks. Royal Canadian Mint reported allocation limits on silver maples due to overwhelming demand. These are not signs of a market with abundant supply and weak demand. These are signs of a market where paper price and physical reality are completely disconnected. Now let's connect this to the Comex data, because the vault movements tell the real story. Comex Gold registered inventory, the portion available for immediate delivery, dropped by 340,000 ounces last week to 8.7 million ounces. That's the lowest level since September 2024. Eligible inventory, which is stored in Comex vaults but not available for delivery unless the owner designates it, increased slightly by 110,000 ounces. But that's irrelevant because eligible doesn't mean deliverable. What matters is registered, and registered is declining while open interest remains elevated. As of Tuesday's close, Comex gold open interest was 512,000 contracts, each representing 100 ounces. If just 5% of those contracts stand for delivery, that's 2.56 million ounces of demand against 8.7 million ounces of registered inventory. The math works, but barely. If 10% stand for delivery, the system is in serious trouble. Historically, delivery rates run between 1% and 3%, but we're not in a historical market anymore. Here's the evidence that delivery rates are changing. In January, 7.2% of expiring Comex gold contracts resulted in physical delivery. That's more than double the historical average. In silver, the delivery rate hit 11.4% in January. These numbers are extraordinary, and they signal something fundamental is shifting. Buyers are no longer content to roll contracts forward indefinitely. They want metal. And when buyers want metal in size, the fractional reserve system that underpins paper gold trading starts to show cracks. The Comex operates on the assumption that most contract holders will settle in cash or roll forward. When that assumption breaks, the whole mechanism breaks. We're not there yet, but we're closer than we've been in decades. And let's talk about China's physical market, because what's happening there is unprecedented. Shanghai Gold Exchange withdrew 387 tons from vaults in January, the second highest monthly withdrawal on record. Shanghai premiums over London spot reached $45 per ounce at one point last week, before settling back to $28 where they are today. A sustained premium of this magnitude indicates structural demand that cannot be met by current import allocations. China allows 1,200 tons of gold imports annually through official channels, but shadow imports through Hong Kong and other routes likely add another 400 to 600 tons. Even with those additional flows, domestic demand is outstripping supply. Jewelry demand in China is actually down 8% year over year, but investment demand is up 67%. Chinese savers are shifting from real estate, which is still in crisis, and from equities, which remain volatile, into physical gold and silver. This is a multi-trillion-dollar reallocation that's just beginning. The bank app crashes in China that we're seeing aren't technical glitches. They're demand surges that exceed system capacity. ICBC, the world's largest bank by assets, reported over 2 million login attempts per minute during peak hours last week when gold prices dipped below $4,400. Their systems couldn't handle the load. Bank of China suspended online gold purchases for 6 hours on Tuesday due to settlement system overload. These are not small regional banks. These are systemically important global financial institutions that cannot process the volume of gold purchase orders coming from retail savers. When the infrastructure itself becomes the bottleneck, price premiums emerge. And those premiums are a signal that supply is not keeping pace with demand regardless of what paper markets are pricing. Now let's address the geopolitical context, because this is not happening in a vacuum. The Trump administration's Critical Minerals Initiative is a direct response to the fact that China controls 70% of global rare earth refining, 60% of lithium refining, and has been aggressively securing supply chains for materials essential to defense, technology, and energy transition. Silver's classification as a critical mineral is significant because it moves silver from the precious metals category into the strategic materials category. This unlocks different types of government support, procurement priorities, and stockpiling mandates. Project Vault, the $12 billion strategic reserve program announced last week, includes specific allocations for silver, lithium, rare earths, and other critical materials. The Export-Import Bank is providing $10 billion in financing for domestic mining projects and processing facilities with expedited approval timelines. This is industrial policy at scale, and it's being driven by national security concerns, not market dynamics. When 50 nations show up to a minerals summit in Washington, that tells you the geopolitical competition for resources has reached a level where diplomatic coordination is necessary. Australia, Canada, Chile, Peru, South Africa, and European nations are all looking to reduce dependence on Chinese processing and refining. But here's the problem. China didn't build its dominance overnight, and it can't be replaced overnight. Building a lithium refinery takes 4 to 6 years. Bringing a new silver mine from discovery to production takes 7 to 12 years. Even with government support and expedited permitting, supply response will take years to materialize. In the meantime, demand is growing, stockpiles are being built, and the available supply for commercial markets is shrinking. This is why premiums are emerging. This is why vaults are draining. The physical market is pricing in a supply deficit that the paper market hasn't fully recognized yet. Let's talk about the Japanese bond situation, because this is the wild card that could trigger another wave of volatility. Japan's 10-year yield hit 2.26% this week, the highest since 1999. The bid-to-cover ratio on the recent auction was weak, indicating declining appetite for Japanese government debt. Japan's national election is this Sunday, February 8th, And if the ruling coalition wins decisively, markets expect another major fiscal stimulus package, potentially exceeding 30 trillion yen. More spending means more bond issuance, means more pressure on yields, means more pressure on the yen, means more pressure on the carry trade. For the past 2 decades, investors borrowed yen at near zero rates and invested in higher yielding assets globally. That trade has been unwinding since mid-2024, when the Bank of Japan started normalizing policy. If yields spike further, the unwind accelerates. When the carry trade unwinds violently, everything sells initially. Stocks, bonds, commodities, crypto, real estate all get hit as leveraged positions are liquidated. We saw this in the initial flash crash. Gold dropped from $5,200 to $4,350 in 48 hours. But then the safe haven bid returned and gold rallied back to $5,100. If Japan's bond market breaks again, we could see another liquidation wave. But the pattern suggests each dip will be shallower and the recovery faster because physical buyers are waiting to accumulate on weakness. The silver market deserves special attention because the fundamentals are even tighter than gold. Global silver mine production was 822 million ounces in 2025, down 2.3% from 2024 due to declining ore grades in Mexico and Peru, permitting delays in Canada and operational issues in China. Industrial demand was 641 million ounces in 2025, up 8.7% driven by solar panel manufacturing, which alone consumed 178 million ounces. Investment demand was 287 million ounces, including coins, bars, and ETF inflows. Jewelry and silverware demand was 204 million ounces. Total demand was 1.132 billion ounces, against supply of 822 million ounces from mining, plus 180 million ounces from recycling, for a total supply of 1.002 billion ounces. That's a deficit of 130 million ounces, or 13% of total supply. This deficit was filled by drawing down above-ground inventories, which is exactly what we're seeing in the vault data. Comex registered silver inventory is down 28% from its 2024 peak. Shanghai silver exchange inventories are down 34% year over year. London vaults don't publish data, but import-export flows suggest drawdowns there as well. At current deficit rates, above-ground inventories available for commercial sale will be exhausted in 18 to 24 months. After that, the market will have to ration demand through price. That's when silver really moves. Now, let's talk about what this means for Bitcoin, because the narrative that Bitcoin is digital gold is being tested in real time. Bitcoin peaked at $106,000 in November 2024, when gold was trading at $3,100, giving Bitcoin a ratio of 34 ounces of gold. Today, Bitcoin is at $76,000, and gold is at $5,100, giving Bitcoin a ratio of 14.9 ounces. Bitcoin has lost 56% of its value, measured in gold terms, since its peak. This doesn't mean Bitcoin is going to zero. It means Bitcoin is a risk asset that correlates with liquidity and speculative appetite, while gold is a monetary asset that performs during uncertainty and deleveraging. They're different things with different use cases. When central banks are buying 127 tons of gold per month and governments are launching strategic stockpiles, that's a different dynamic than venture capital funding rounds and retail speculation. One is monetary legitimacy. The other is technological speculation. Both can exist, but they're not substitutes. Let's address the Iran situation because geopolitical risk remains elevated. President Trump stated yesterday that talks are ongoing with Iran, but that all options remain on the table. Israel conducted airstrikes in Syria on Tuesday targeting Iranian-backed positions. Oil prices spiked briefly before settling back. Any military escalation between the U.S. or Israel and Iran would immediately trigger safe haven flows into gold and silver, spike oil prices, and create broader market volatility. This risk hasn't gone away. It's been postponed. As long as tensions remain unresolved, the market will maintain a risk premium, and that premium benefits hard assets over financial assets. History shows that geopolitical risk is underpriced until it's not, and when it reprices violently. Here's what the data is telling us when you put all the pieces together. Central banks added 127 tons in January, while ETFs lost 89 tons. That's a net swing of 216 tons from weak hands to strong hands. Comex delivery rates jumped to 7.2% for gold and 11.4% for silver, more than double historical norms. Shanghai premiums are sustained at $28, indicating structural demand. U.S. Mint and global mints are seeing record demand, with delivery delays extending to 6 weeks. Vault inventories are declining across Comex, Shanghai, and implied London drawdowns. Industrial demand for silver is growing 8.7% annually, driven by solar and electronics. Governments are classifying silver as critical and launching stockpile programs. Geopolitical competition for resources is intensifying, with 50 nations coordinating on supply chains. Japan's bond market is under pressure with potential for another carry trade unwind. Iran tensions remain unresolved, and prices have recovered $6 trillion in market cap in just 48 hours after the flash crash. The picture that emerges is one where paper markets are volatile and driven by leverage and algorithms, while physical markets are tightening and driven by structural demand and strategic positioning. These two markets are diverging, and when they diverge, eventually they must reconcile. Reconciliation happens through price adjustment, delivery failures, or market structure changes. We don't know which comes first, but we know the direction. The question is not if physical shortage forces price higher. The question is when, and whether there will be one more shakeout before the final leg up. The Japanese bond auction tomorrow will give us more information. The election in Japan on Sunday will give us more information. Any developments with Iran will give us more information. But the underlying trend is clear. Supply is tight, demand is strong, inventories are falling, governments are positioning, and central banks are accumulating while retail is selling. For those holding physical metal, the volatility is uncomfortable, but the thesis remains intact. For those looking to enter, dollar cost averaging on dips makes sense given the volatility environment. But waiting for the perfect entry means risking missing the move entirely when physical shortage becomes undeniable. The premiums we're seeing in Dubai, China, and at mints globally are early warning signals that obtaining physical metal is getting harder regardless of what paper price says. And if you can't take delivery, you don't own metal, you own a promise, and promises are only as good as the institution making them and the liquidity available to honor them. In a deleveraging environment, both of those assumptions are questionable. Watch the vaults, watch the premiums, watch central bank purchases, watch government actions. The price will follow eventually, but the physical signal comes first. The signal is flashing. Do your own research, understand the risks, but understand that $6 trillion recovering in 48 hours while vaults drain 5.9% per day is not normal. Central banks buying 127 tons per month while ETFs bleed 89 tons is not normal. Comex delivery rates doubling is not normal. These are structural changes happening in real time, and the implications are significant. Think independently. Act accordingly.